Now, semi-strong form market efficiency. What do you mean by that? Well, public information, right, cannot predict future returns. Why? Because all those current public information is already priced in the market, or it's already reflected in the price. Okay. Now, what's the, how do you say, idea against this semi-strong form market efficiency? That's Warren Buffett's idea. You know, Warren Buffett and then Chicago economists, they don't go hand in hand, right? They are conflicting with each other. In what sense? Isn't Warren Buffett a guru in economics? Yeah, he is, but about the ideas about, or the belief about the degree of efficient market hypothesis is very different, right? Warren Buffett doesn't believe in efficient market hypothesis, at least about the semi-strong form, okay? In what sense? Let's say here is his idea. Let's say this price chart, price is red graph over here, and today this is time point 0 and you stand over here. And as it turns out, you, like a Warren Buffett, study this company. Let's call this company maybe, I don't know, what company could it be? Kakao Bank that you're going to value. The price is over here, okay? But after careful valuation, you realize, after careful DCF, discounted cash flow method, you estimate the true value of the company to be big V over there, true value, which is substantially bigger than current market price. Is market efficient? And you believe it's not. There's a deviation like this. You found an opportunity, investment opportunity. So what do? Buy! Click buy button. And hope and pray that the price will eventually converge to the true value. And then by that time, you will sell off and then make money out of it. This will be your profit. Oh my God, you feel rich, right? But, for how long would it take? Would it be 1 month, 1 year, 10 years? I don't know. God knows. But the thing is, more important thing is, we sure are the only smart people in the market, but you are not alone. And if your investment idea or DCF idea is correct, all those assumptions, and then your framework is correct, and everything is correct, and you are smart, and given that you are not alone, everybody in the market is as smart as you, okay? Very competitive anyway. So they get the same information, public, right? What would they do? They will join you in clicking the buy button like crazy. Buy, so that the demand increases like crazy for that stock. And then the price will shoot up to the target level instantaneously right now. And then start to do a random walk from now on. Okay? This is what we mean by the public information is priced right now already. Okay? And then from then on, given that there is no additional information coming in over the next time horizon, the price will do a random walk like crazy. Up and down and up and down. We are, right? Like that. So that on average, the price will stay the same. Right? On average, they will stay the same. What do you mean by that? On average, they stay the same. I see only the price moving up or down or walking like a random walking like nowhere. I don't see anything moving, staying the same. What I'm claiming over here is that if you do the experiment like 1,000 times, like for example, if there were multiverse or repetitively, if you could test it, right? For the same company, let's say starting with, what did I say? Tesla? Right, okay, fine, Tesla. The price, you only see one realization path, or we call it sample path in engineering terminology. One realization would be like yellow line over here, so that you end up over there, right? Time already has gone, and then the situation and the environment has gone, right? So there is no way of testing whether the Tesla could have gone to the other side like that or this way, or the alternative pricing path. But if you lived in we are living in multiverse, so you move to a different multiverse Earth or parallel world that you see Tesla and then no information, and then see the price getting realized in different way. Okay, you may end up with totally different outcomes like that instead of the yellow one. Okay, that's what we mean by multiverse or things like that, different realization or sample path. If you remember if you watch the movie Source Code of 2008 or something, the movie repeats itself to the moment where there was a bombing of Amtrak by a terrorist. So that his mission is going back to the minute before the bomb shelling, and then eliminate that, inactivate those time bomb of the Amtrak. And he first attempts this way and that way, and every time he gets killed and gets back to the moment before this explosion, and then try to find out who was locating that time bomb and then eliminate it somehow. That's repetitively going back to the same situation. It's just like that. You start with the same information point, and then other than that, it's the same true value. Okay, that's what we mean by sample path. This is more advanced concept. So if you don't understand it, you don't have to digest it right now. I'm not going to ask you for undergraduate level test, but for graduate levels, I will ask him. Anyway, so that's that. On average, it will stay the same once the information gets released and gets announced, right? So the pricing pattern will be flat after the announcement is done. But at the moment of the announcement, the price will shoot up like crazy or shoot down like crazy. It will be a jump of the price. Here is one interesting case. Yahoo versus Microsoft, right? In 2008, February, the 1st of February, Microsoft announced that they're going to take over Yahoo, right? And then the Yahoo was a search engine, and then before Google, it was the most important search engine. But the coming of the Google, the Yahoo's heyday has gone, and then the price has become more depressive. Now, still, it has some good technologies over there, and it was valuable, so the Microsoft was attempting to take over at the price of $32 per share or something. Okay, so they announced that they're going to take over for $32 per share. What happened to the stock price on the day of the announcement? It jumped up like this. And if you look at day by day price pattern, it looks like there is a slope going up like this rather than a jump. But if you look at the microstructure level, which is like intraday level price movement, this is what happened. I just captured the screenshot like this. So on the first day, right before the opening of the market, they announced the takeover, and then the price jumped up to the $28 level, and then it largely walked a random walk like that. It stayed flat like that. Okay, if you remember to join the IPO market or 따상 kind of situation in Korea, when the stock hits the price limit immediately right after some announcements, you will see what I mean by this one. Okay, there's no chance. Only if you purchased the Yahoo stock at this point, right, one day before, and then you could have gained this much. But there is no chance for that, right? Why? Before the announcement, they could not announce this, and they could not release and then leak the information. If they leak the information, and then if you try to make money out of it, right, or you will be, jailed, right? It's insider trading, outlaw, not allowed. There's a strict Chinese law going on. That's why. The opportunities are gone with the wind. Or, in Korean way of saying it, the bus은 떠났어요. Bus is gone already. The bus of profit. Joining the bandwagon, it's already gone. Right? Come on. No way. No soup. No chance. Example. How P reacts to news in a semi-strong, efficient market. Well, we solve for pre and post announcement period. For example, illustrate key principle in this example illustrates the key principle. In efficient market, price jumps and then to reflect the new information about it. Okay, expected cash flows expected cash flows and discount rates. Moreover, in an efficient market, nothing else besides new information can affect price. As long as the information is about the price, the cash flow, and then the discount rate, nothing else matters. And then strong for market efficiency. Well, it says that all information, including private information, right? They are all reflected in the price. That's what they say, right? Testing strong form EMH. Well, even the insider information is reflected in the price now. That's their claim. The insiders cannot make money. That's their claim, the Chicago guys. But many research found that insider trading still makes money, which means strong for market efficiency is denied. So early research results did not support strong form EMH mostly. And can we make money by some trading strategies? So in that sense, neoclassical economists say, no, Jose, right? There's no free lunch in the market. Investment strategy, good luck, right? Investment strategy, my eyes. Because you are not alone. Maybe all the investors in the market are so smart that I am the least, right? I am the lower bound. So they are fastest in information collection and processing the information, so that there is no room for me to make money. That's why I'm professor over here instead of working as investors in the Yoido or Wall Street, right? Many people ask me about investment strategy, but today in the lunchtime as well. Strategy professor, Professor Sang-Kyun Kim was asking, is it a good time to buy a stock or not? I don't know. I'm the least. I'm here as a professor. There's a reason why, right? Market is efficient, right? That's my defensive way of, avoiding tough questions. Anyway, and then another point is that, those neoclassical economists, well, when they walk in the street and then find out some $100,000, check lying on the ground, they don't bother to pick it up. That money. Why? If it should be a real money, the profit-taking opportunity, there's no free lunch in the market. They know so much, so that, given that the free lunch seem to be available, that must not be the free lunch. That must not be the real money. Okay? I'm not going to pick up. That's this philosophy of the Chicago, Minnesota, Carnegie Mellon guys, right? Economists, neoclassical economists. Very depressing. No chance to make money. So what's their best investment strategy? Be a passive investor. Just buy those ETFs about the market index, KOSPI index or S&P 500 index, and ride onto it. And you will be just performing as good as the average, guys, right? Just be as good as average. It's better than being worse than the average. That's it. And then neoclassical versus behavioral finance debate. The question is, are prices completely rational? Is the financial market completely efficient? Neoclassical finance guys, yes, they are 100% rational and efficient. Those guys are located around the Great Lakes. Chicago, Minnesota, Carnegie Mellon. School of thoughts, right? 주류 경제학. All right, mainstream. Behavioral finance guys, we say no. In some cases, prices can deviate from fundamental value and become mispriced. Prices can do this because investors make mistakes which are not always corrected by other traders, right? Those guys are located everywhere else, right? Everywhere else, I say, right? Economist versus psychologist, right? Milton Friedman is a Chicago economist. And then Sigmund Freud, I just show his face over here as a psychologist representative, right? Behavioral finance is like mixing these two, right? That's my way of understanding it. So, thanks for watching until now. Next video, we're going to talk about why EMH is so important. Thanks for watching.